Hey guys, have you ever wondered why we put the nominal interest rate on the money market graph? That's right, the nominal interest rate is the variable on the vertical axis and not the real interest rate. Well, that's what this video is about. Now, I need to set this up a little bit, okay? So here is the deal. When you are in a foundation or principles economics class, you have two different models you can go to for what we call interest rate determination. Now, I'm gonna explain that whole thing. First of all, the two models that you can go to. One is this one, the money market. The other one is the loanable funds market. So what do I mean by interest rate determination? Well, things happen in our economy, okay? Things change in our economy. We call these shocks. And we need to know which model we should go to, whether it's the money market or the loanable funds market, to find out what's going to happen to interest rates. Now, the interesting thing is the money market has the nominal interest rate on it and the loanable funds market has the real interest rate on it, okay? And this video, again, is about why does the money market have the nominal interest rate. I'll have a different video on why the loanable funds market has the real interest rate. And by the way, I already have a video out there for explaining when you should go to the money market and when you should go to the loanable funds market. So if you want to understand, hey, when do I go to these two models or one or the other model for interest rate determination, I have a video already out there for you on that. Now, let's get back to this one, okay? Why the nominal interest rate, okay? It really has to do mainly with the decision being made by the actors that sit behind the money demand curve, okay? Now let's talk about both curves very quickly, okay? The money supply curve, guys, that curve is determined generally by the central bank of a country, okay? In the United States, that would be the Fed. So especially in a limited reserve framework, we'd be focusing on the Fed changing the money supply. So the Fed does some type of action, again, in a limited reserve framework, they'd be changing the RRR, the required reserve ratio, or the discount rate, or doing an open market purchase or an open market sale, okay? And that changes the money supply. And generally speaking, economists like to say, hey, if the Fed is just changing the money supply, okay, increasing or decreasing it, they're affecting nominal interest rates directly, okay? Because the changing of the money can't directly change the real interest rate of the economy, which should somewhat be tied to the real return of investment in the economy, okay? All they're doing is changing the amount of money in the economy, so it's changing the nominal interest rate. However, this video is not going to focus on that money supply curve and really what I just went over right there. It's going to focus on the money demand curve as the primary reason why we have the nominal interest rate. So here is the deal. What you need to understand when it comes to the money market is what is the decision that's being made by the actor behind this particular curve. And the decision is about how to allocate their wealth. That's right. It is not about borrowing and lending. That is so critical that students understand. It is not a borrowing lending decision. Their decision is how they're going to allocate the wealth. A better way to say it is how liquid do they want their wealth to be, okay? In other words, guys, there is another name for the money market, okay? It's actually a name for this model that I personally prefer. It's called the liquidity preference model. That's right, the same thing. The money market can also be called the liquidity preference model because the money demand curve is showing, this is what it's showing, is our preference in the aggregate of holding our wealth in liquid form. Now, let me explain that. When you hold your wealth in liquid form, that means basically as M1. You can see the M1 right there. Now, what is M1? M1 is currency, just holding it as currency, or in your checking account, a demand deposit, or in your savings account. Now, the savings account has made things a little bit more difficult to talk about when it comes to the money market and the nominal interest rate. That's a new addition to M1. When this model was constructed, it was simply currency, okay, in circulation, currency held, money in your checking account, your demand deposit, and traveler's checks, okay? And here is the big thing. All of those assets, okay, provide no nominal return or a very low nominal return. The easiest one to talk about is, of course, currency. What I mean by no nominal return is if you hold your wealth as currency, say $500, and you just hold your $500 in currency, like put it in your wallet, right? And you hold it there for a year, how many dollars are you going to have at the end of the year? $500. The nominal return, the percent increase in dollars that you're going to get is going to be zero. So no nominal return. Check checking accounts pay a very low nominal return, and oftentimes no nominal return. Traveler's checks play no nominal return. Savings accounts do pay somewhat of a nominal return, but it's oftentimes very, very low. And again, it kind of messed up the conceptual basis of this model. That's okay. I just really don't want you to focus on those so much, because I want you to go back to when this model was conceived and created, and it was about, hey, if you hold your wealth in liquid form as money, you're going to basically get no or a very low nominal return, okay? Nominal interest rate, basically. Now, here's the thing. You can also hold your wealth as other assets. What do I mean as other assets? As stocks, bonds, and real estate. Those would be some of the big ones, right? And if you hold your wealth as these other assets, you are actually expecting a nominal return. You're expecting that in the future, you'll be able to get more dollars than you use to purchase these assets, right? So when you sell them, right? So you're buying these assets today, it takes a certain amount of dollars, and when you sell them in the future, you're expecting more dollars, okay? So you're expecting some type of nominal return. So here is the thing, the money demand curve, okay, which is modeling our preference for holding liquid assets. The money demand, your demand for liquid assets, for money, M1, okay? And you can see this inverse relationship, okay? When you do that, again, you're getting no nominal return, but if you held your wealth as these other assets that provide a nominal return, hey, that would be the opportunity cost of holding your wealth as money, and that's why it's got the inverse relationship. As that nominal return of those other assets goes up, you're going to want to hold less of your wealth as money. Now, before we go any further, why do we hold any of our wealth as money? Since it provides just about no nominal return, and those other assets we're supposed to think of are going to provide a nominal return. 4 major reasons, okay? The first one is transaction demand for money. You need money to buy goods and services, kind of the basic need to buy the goods and services in your life. Think of it as paying your utility bill or paying your rent. That's transaction demand for money, and that's what makes up this vertical component of the money demand curve, which is interesting. What we're actually saying is your demand for money to do your basic transactions in your life is not sensitive. That's right, that's a completely inelastic line right there, or segment of the line. This is only representing transaction demand for money, okay? It's not sensitive to the nominal interest rate. But then there's other reasons to hold money. They mainly fall under asset demand for money, and I like to say there's 3 of them, okay? There's cushion, there's convenience, and there's speculation. So here's what I'm saying. Why do we hold money? 1, to do basic transactions, and then above and beyond that, we hold money for convenience, cushion, and speculation. Let's talk about convenience. Both my wife and I hold some cash in our wallets. We don't do it because we're expecting to use that cash at any given time. Sometimes that cash might sit there for weeks and weeks and even months, okay? But it's there for convenience sake. Oh, this is a situation where I need cash. I'm glad I've got some cash. So we hold some for convenience. Cushion. Think about our checking account, okay? My wife and I don't put the exact amount we think we need in our checking account for the amount of bills that we're gonna have paid, okay? So, of course, during the course of the month, we have money that comes out of our checking account to go pay our bills, whether it's our credit card bill or our mortgage or whatever. We don't put the exact amount. We put some cushion in there, some extra money in there, right? We like our checking account to have some cushion. So there's the cushion. And then finally is the one that Keynes focused on, John Maynard Keynes, and it was the speculative aspect. The idea is, hey, we might hold some cash, okay, for at periods of time when we're looking or we're speculating that the stock market or maybe the real estate market is going to have a dip, okay? The prices are going to come down, and we want to be able to go buy those assets. That's what he meant by speculative purposes, is, oh, I think maybe those assets are overvalued right now, so I don't want to put my cash into those assets. I'm waiting for a time period where those asset prices come down and I can go buy them. That's the speculative aspect. Now, for convenience, cushion, and speculation, okay, there is a cost. There's a cost to holding the money, and that is that nominal interest rate, and you care about it. It's this, you're sensitive to it. Let me say that a little bit different, because I think that might have been a little bit confusing. When you hold your money for transaction, there is a cost to it, but you have to buy these kind of basic goods and services in your life, so you're not sensitive to the nominal interest rate. For the other reason, the asset demand for money, for the cushion, the convenience, and the speculation, you are sensitive to the nominal interest rate. You're only going to hold so much cushion if the cost of holding money gets higher and higher. You're going to only hold so much for convenience sake as the cost goes up. You're going to hold only so much for speculative purposes if the cost of holding money goes up. So that asset demand for money, and that asset demand for money is basically our demand for the asset money above and beyond our demand for the asset money to do basic transactions, okay? That's what we're talking about there. Whew, okay. So again, the money demand curve, it's not about borrowing and lending. It's about my preference or our preference of holding our wealth in liquid form versus holding our wealth as a different asset. And when we hold it as liquid form, we're going to get basically no or a very low nominal return. When we hold it as other assets, we're going to get a nominal return. It's the nominal return we care about. So let's go through a few scenarios. We'll wrap up this video because it's already kind of long. Scenario 1 and scenario 2. Here's the thing I want you to see. The real interest rate is very different, but it is not changing my motivation. My motivation to hold these other assets besides money is the same in scenario 1 and scenario 2. Why? Because the nominal interest rate is the same. I don't care that in one the real interest rate was 0 and in the other one the real interest rate was 12. In both situations, okay, scenario 1 and scenario 2, if I don't hold my wealth as money but hold it as some other asset, I'm expecting when I hold this other asset to get a nominal return, a nominal interest rate if you want to say it that way, of 12% in both of these. So what does that mean? If I hold my wealth as money, $500, right? Hold it for the course of a year, all I'm going to have is $500. But in this situation, I could have taken that $500, bought an asset, and guess what? I'm expecting to have $506, which by the way is a 12% nominal return. Okay, in both situations, I'm getting a 12% nominal return, 12% more dollars, okay? And 12% more dollars is 12% better than 0% more dollars. So in both situations, yes, I am motivated to maybe hold other assets, maybe significantly, because 12% is kind of high, all right? I'm motivated to hold it, but I'm equally motivated in both scenario 1 and scenario 2, even though in scenario 1, the real interest rate was 0, and in scenario 2, the real interest rate was 12. So I'm not really caring about the real interest rate. I'm caring about the nominal interest rate. If that didn't bring it home, I think scenario 2, again, I'm bringing scenario 2 down here, okay? And scenario 3 might really bring it home. In this situation, okay, the real interest rate is 12%, okay? The nominal interest rate is 12% or 0%. In scenario 3, what's going on here, guys, is we're actually expecting deflation, okay? We're expecting the price level to go down by 12%. Now, here is the deal. In scenario 2, I'm significantly motivated, okay, to go hold less of my wealth in liquid form because I have an opportunity cost of 12% nominal interest rate and nominal return of 12%. So hey, I'm pretty doggone motivated to move a good amount of my wealth, not hold too much for convenience, cushion, or speculation into these other assets. I can get the nominal return of 12%. How about 0%? In this particular case, the opportunity cost of holding my wealth as cash, or I should say in liquid form, which means yes, cash or checking account or savings account, my opportunity cost of holding it in liquid form as M1 is 0. That's right. If I went and bought one of these other assets instead, like, oh, I don't want to hold my wealth as cash, I want to hold it as stocks or bonds or whatever, real estate, the expected nominal return of these other ones is 0%. And here's the deal. If I just hold cash over the course of a year, I'm guaranteeing myself a nominal return of 12%. Let me say that again. If I just hold my wealth as M1, right? Especially let's just think currency, right? That $500 is going to remain $500. I'm guaranteeing myself a nominal return of 0%. And remember, there's advantages of holding your wealth as cash: transaction demand, convenience, cushion, and speculative reasons. And there's no cost to me of doing that. If I go hold my wealth as these other assets, I'm only expecting, again, a 0% nominal return, what I can get by holding cash. So basically, it's free to hold your wealth as cash. I am not motivated to hold these other assets. I'm motivated to hold my wealth as cash. Even though the real interest rate is the same, I am not motivated at all to hold these other assets. I'm just going to hold cash. In this one, I'm quite motivated to hold the other assets. Again, when it comes to the money market, the liquidity preference model. It is the nominal interest rate that we put on the vertical axis because that is the opportunity cost of the decision maker that stands behind the money demand curve. When it comes to the decision that they're making, and what is that decision? It is not about borrowing and lending. That decision is about, how do I hold my wealth? Do I hold it in liquid form or in these other assets? Okay, there you go. That's why the nominal interest rate goes on the money market. Whew, if you stuck with that video, I'm impressed. We'll see you in the next video.